What are the most optimal ways for your company to make revenue? What are the most important costs? In this video, we discuss company financials, which include the revenue streams and cost structure. The cost structure indicates how companies use most of their resources to generate demand for their products and services. The cost structure and revenue streams help to assess the operational scalability of an organization. Cost structure includes all the costs related to the business model, the operations of the company. The overall costs must match company key activities. The main models include cost and value-driven models. The cost-driven model aims to minimize costs, whereas the value-driven model focuses on creating value. Companies must pay attention to the key activities versus resources and revenue streams to map out the overall cost structure. The fixed and variable costs determine the overall cost structure and profitability. Fixed costs mean those costs that remain the same despite the volume of goods or services produced. Examples include salaries, rents, and physical manufacturing facilities. Variable costs are costs that vary according to the volume of goods or services produced. A business high in variable costs can manage with relatively low incoming revenue. Entrepreneurs and company managers can influence the cost structure when building the business model. Especially nowadays, digital machinery or automated equipment reduce some of the variable costs, such as personnel costs. However, the use of various digital tools requires specific digital skills. Deciding between fixed and variable costs requires careful financial management and ethical decision-making. When establishing a cost structure and calculating the profit margin, companies should evaluate the following: the key costs of the business model, especially the most expensive activities and resources. The key activities versus the chosen value proposition. The cost structure in the long term. Will costs remain fixed or will some become variable? Is the business model cost or value oriented? The costs of goods sold and the cost of sales versus the costs of production and delivery. To map out the pricing strategy and to position the company in the market, you need to analyze the customers, the current products and services, together with future aims. These should be placed in accordance with measurable indicators for the activities to be carried out. To map out the revenue streams to the value proposition, company must consider what is the price customers are willing to pay from the value received and to find out the best ways to generate revenue. Company pricing strategy determines how a company generates revenue and can succeed in the market. Are you focusing on fixed pricing, which is more static, or on dynamic pricing, which is based on market conditions? Mapping the revenue streams must include the ways and channels how customers are reached for them to complete a purchase. The value perceived by the customers enhances the overall customer experience, which contributes to an increase in revenue. Consider, could you develop various revenue stream channels or redevelop the existing ones? Revenue streams are divided into two categories. The first one is the transaction revenues, which refers to one-time customer payment. The second one is the recurring revenues, which are gained from ongoing payments from delivering the value propositions or, for instance, from customer support services after the purchase. Examples of revenue streams include usage fee, leasing, licensing, asset sale, advertising, and subscription fee. The revenue model of a company consists of the following: who pays, what is paid, for what is paid, how is paid, and how much is paid. Thank you for watching. The sixth video introduces the concept of management.